Zacks Know Your Options, a weekly overview of unique option strategies and ideas designed to help you beat the market no matter which direction it's going. We're talking about intrinsic value versus time value with our options guru, Kevin Matras, who joins me here now. Now, this is something that you and I have talked about in the past, and whenever we talk about it, it's always clear that you feel this is an important concept in options trading.
Oh yeah, I would say it is probably one of the most important concepts. Understanding the difference between intrinsic value and extrinsic value, key to understanding options, and it is really the key to whether or not your trade is going to turn out to be a winner or a loser. Very, very important stuff.
All right, so you always like to start with definitions.
Right.
Throw one out at us.
Well, first off, the definition of intrinsic value really is the amount of value that the option is in the money. So here is a slide. So the in the money or the intrinsic value is determined by the difference between the underlying stock price and the option's strike price. So, for example, if the stock was trading at $50 and there was a $45 call option that was selling for $6.50, that option would have $5 worth of intrinsic value. So the way the math works out is $50 stock minus the $45 call, that's $5. So if the option premium is worth $6.50, that means $5 is intrinsic value, or in other words, 77% of that option is comprised of intrinsic value. The other $150 is comprised of extrinsic value.
Now define that.
Extrinsic value, here's another slide, is the amount of premium that is out of the money. So this part of the premium is said to be your time value. Out of the money options are comprised of only time value. So to be able to continue with that example that we used before, if you have a $6.50 premium, if $5 is intrinsic value, the $150 is comprised of extrinsic value. So 77% is intrinsic, the other 23% is extrinsic or time. So it is very, very important to understand the difference when you are making your option selection.
Okay. And the difference to the investor would be?
At the very, very beginning, if it really doesn't matter. So if, let's say, you bought an option for $500 and then you sold it a short time later for $800, you've made $300. And whether 50% of that option was comprised of intrinsic value or no part of that option was comprised of intrinsic value, it doesn't really matter at that point in time. But at expiration, it absolutely matters. It is a critical thing because at expiration, your option's value consists exclusively of intrinsic value. So that is where push comes to shove, and that is where it will be determined whether you are profitable or unprofitable on your trade.
All right. You have an example?
Yeah, so let's check out some slides here. If I had a $50 call option, and let's say there was 2 months of time on it, and the price of the underlying stock was $45. That option might be worth $350, or in other words, $350. So in this example, I have an out-of-the-money option, okay? And again, at this point, this option is comprised of only time value. Continuing on. So now, fast forward 2 months. If that stock is still at $45, that option is $5 out of the money, meaning it has no intrinsic value. And since it's now expiration, the time has run out, which means there's no time value. That means that that option is now worthless. So you would have lost everything that you paid for the option. Now, on the other hand, let's say that stock was at $53 at expiration. So it has risen from 45, now it went to 53. So now it's $3 above your strike price. All of the time value has still disappeared, but it now has $3 worth of intrinsic value, which means your option is now worth $300 at expiration, and that's one of the key differences. Because in that first example, the option really didn't, or the stock didn't do anything. It never reached your strike price, which meant there was no intrinsic value at expiration, and you lost it all. In the second example, at expiration, the stock actually reached and exceeded the strike price, which meant you still lost all of the time at expiration, but since there was an intrinsic value component to the option, that is what made that option have any value. You still lost, in this example, you still lost $50, but losing $50 is much better than losing $350 on your option.
So that's why you like to buy in-the-money options?
Correct, because when you're buying an in-the-money option, you already, in my opinion, are starting off at an advantage, and it turns the risk to reward profile totally in your favor. So what I've realized is that when most people buy options, the problem is that they either have too high of an expectation of what they think the underlying stock will do, and they think this spectacular move is going to happen way too quickly. So what they will typically do, because everybody gets excited once they're getting ready to buy a stock, the next very stock you buy you think is going to go to infinity. That's what everybody thinks. Otherwise, you probably never would have bought it.
They don't?
Yeah. So,
is that where I went wrong?
Right, that's a problem.
Okay.
Take a note of that. So the problem is that they will usually scrimp on time, and they will really increase their leverage by buying a bunch of junky out of the money options. The problem is that most times stocks are not making explosive moves. They will, kind of just meander about and go sideways. So if you buy an out of the money option and your stock goes sideways, or even if it goes up a little bit, it never reaches your strike price, you're going to be saddled with a 100% loss on the premium. However, if you bought an in-the-money option, it is true, it may cost you a little bit more money, but if that stock were to go sideways between when you bought it and expiration, you're only going to lose a portion of your premium. You're going to be able to get back a tremendous amount of what you put in. So if let's just say that you bought an option that was comprised of 77% of intrinsic value, like in our previous example, you're going to get 77% back of what you put into it, as opposed to losing 100%. The other benefit too is with that out of the money option example, even if the market moved up a little bit but never reached your strike price, you're losing everything. Here, you're already in the money. So if the market goes up even a little bit, oftentimes that will make that in the money option that you purchased, not only are you getting your money back, but you're actually turning that into a profitable trade. So I believe the key takeaway is when you are faced with a choice of which option do I buy, I would almost every single time tell you, go for an in-the-money option, because if things don't turn out picture perfect, and they usually don't, you're going to be able to either break even or make a small profit, whereas if they don't turn out picture perfect, you're going to give up 100% of what you put in on an out of the money option, and that is where most people screw themselves up with options.
And while this concept seems straightforward enough, I can see, and probably the viewer can too, where it is a concept that needs to be fully understood.
Yeah, fully understood, but again, it's not rocket science. If you just put a little bit of time into it, just spend 10, 15 minutes, taking a look at what some of these terms mean, you'll realize, wow, options really are a great tool. This would be a great addition to my portfolio, and it really can help an investor beat the market with a very small amount of money involved.
All right, until next time, Kevin Matras with me, again, providing you with information to help you know your options. Not rocket science information. I'm Terry Ruffalo.